We run momentum studies of these charts too. In fact, later on we'll look at one regarding silver. But the point is that when you get this kind of breakout, and its momentum has also done the same thing except earlier, it's saying something big. It's saying this is a monstrous base of monetary metals holding their ground versus the paper bubble. Everybody's cheering the stock market for the last 10 years, but nobody's noticing that you could have flipped a coin every 6 months and either been ahead or behind in gold relative to the stock market, but basically net sideways, meaning as well as the S&P. Nobody notices that. And I love that because they notice it later, But anyway, this is a breakout and it indicates something. You're not going up for 2-3 months here. This is going up for a couple of years. And God knows where it's going. But this is a massive base. It will have a massive move, and it just began. So people who look at a gold chart say, oh my gosh, that's so steep, it's gained so much ground. They need to step back a bit. We measure the very long-term momentum metric of the dollar index. Now, this doesn't express the dollar's true buying power. It expresses its relative value versus other fiats, okay? So it's, like one piece of this versus another piece of this, okay? Pardon me, I didn't use the right word. The dollar index has been in a massive staircase decline since the 1980s. In fact, that one of the charts on that report just shows that. And when people talk about the strong dollar, what are they smoking? I mean, when you stand back and look at the last decades of the dollar index, it's just blob, gets a rally, multi-year rally, blob to another low, rallies to another lower high. It's a decaying process. We think the next leg down has commenced. We think it commenced at the close of March of this year. And at that point, it was dropping sharply. It was at 104.21 to be precise. Right now, we're trading in the 98s. After that 104.21 close in March, there was a sharp drop in April and into early May. Hey, what happened at the same time? S&P had a sharp drop into April, okay? And then S&P rallied and rebounded. I mentioned this S&P to the dollar because so many people think they're not correlated. To some extent, they really are. When you look back over the last 30 years, major highs, major lows are often fairly coincidental, and broad trends are coincidental. But anyway, so the dollar index broke structure on annual momentum. When you plot the annual momentum chart of the dollar, you see a slightly different picture than when you look at the price chart going back, let's say, the 1980s. There was a 13-year uptrend line on momentum that wasn't evident on the price chart.
A key shift occurred when annual momentum, an indicator that often reveals trend changes earlier than price, broke long-standing support this spring. The decline accelerated, briefly touching the mid-90s before stabilizing in a narrow range. Meanwhile, equity markets staged a confident rebound. Yet historically, the dollar and the S&P 500 often move in tandem during major turning points. This divergence raises questions. Is the stock market signaling resilience or merely lagging an overdue correction? With the dollar showing persistent exhaustion and failing to recover from April's breakdown, the data leans toward renewed downside pressure in both assets.
We blew it in April. Sure enough, we dropped to 96 area. Since then, as the stock market has been rallying off its April low, the dollar has been holding around and above its April low, but really not mustering a rally. It gets like a 2, 3, 4 point rally and it goes boom, right back down. Back up again, whack it down again. It's in a range, a very narrow single percent digit range in price that isn't getting off the mat. It got beat down in April and it's just laying on the mat, lifting its shoulder and getting whacked back down. The issue is it going to continue down? We argue yes. It would not surprise us that the low that was made, it was at 2008, I think it was around in the low 70s on the dollar index. Right now we're in the upper 90s, could come out. In other words, a whole new leg to a new low. Its correlation to gold. Now, everybody thinks, well, as the dollar goes, no, it's the decay in money units, period, not just the dollar that drives gold. But actually, look, if you look back at where gold was in December of 2015, it made its bear low at 1,050. It's 4 times that price now, okay? Go back to the dollar index in December of 2015. It was in a rally phase and peaked for a while in the 98 area, right where we are now. So if you draw a line sideways back to 2015, we've gone either side of that number on the dollar index, yet gold is quadrupled. So my argument is the decay in the dollar is important relative to the others, but ultimately gold is driven by ongoing decay in all the paper money units, not just the dollar. Okay. And the dollar competes nicely with all of them. As you can see on the dollar index chart, it's very anemic. Okay. Anyway, so that's a background factor. And it's arguing, if I'm in sync with the stock market, if the stock market's in sync with me again, I didn't get much rally off my April low. S&P did. Which one's lying? Are they going to divorce, or is the S&P merely teasing us, which is what we argue technically, and it's going to join the dollar? That would be our argument.
Gold's ascent is not simply a reaction to a weaker dollar. It reflects global decay across major fiat systems. Since 2015, gold prices have quadrupled, while the dollar index has moved sideways within a narrow band. This disconnect highlights a broader truth. Gold responds to the loss of confidence in currency units generally, not in isolated exchange rate shifts. The euro and yen, comprising most of the dollar index, face similar structural challenges, from negative demographic trends to heavy sovereign debt loads. Against this backdrop, gold continues to assert itself as the monetary benchmark amid an era of collective currency dilution.
We don't look at the fundamentals as such. There's some meticulous analysts who look at each currency unit and the government spending and all that. We view it as one big team of slush, okay? And the issue is which one sinks faster than the others. And it's hard to believe that the dollar index is worse than the euro and the yen. They constitute 70% of the dollar index. Euro is 57% of the dollar index. So it's really not much of an index. It's two currencies against the dollar. You got the Canadian in there and a couple others, and the British pound, and so forth. But really, it's the euro and the yen, and it's hard for me to say the dollar looks weak compared to those two pieces of paper. But that's the game we're playing. We're playing with the three pieces here, essentially, of worthless, ongoing, decaying money units. Okay, yeah. So it's hard to me to be boisterous about any one of them, to say, oh, the euro looks good. You get my point.
A powerful signal is emerging from the ratio of gold versus the S&P 500. After drifting sideways for nearly a decade, the spread recently broke above a multi-point trend line that has capped every rally since 2014. In financial analysis, such a breakout often marks the start of a multi-year reallocation, not a short-term swing. This suggests capital may be gradually rotating away from equities and into monetary metals. The November close confirmed this structural shift, implying that gold's renewed strength isn't a spike, it's a new cycle, potentially lasting years as investors seek shelter from systemic vulnerabilities.
When you can see a structure on a momentum chart, structure like, a good trend line, like if you saw it on the price chart, the uptrend was hit 4 times, let's say, and then the 5th time you broke it, you'd say, I better sell that, right? Okay. Right. Well, that happens on momentum usually almost all the time before price smacks you in the face with a similar move. So that's why we're focused on momentum. It usually leads trend changes. In this case, we're talking about an annual momentum trend change. Those trends tend to last, not just 6 months or so, but, several years. And what the dollar's been doing, since Nixon's time is nothing but big slabs of decline relative to these other pieces of junk. So, and again, to try to link it to the gold movement is not if you looked only at the dollar index since 2015, it's been above that level and below that level. So what did you do? You don't buy gold, right? Because the dollar's just sideways. Well, you missed a 4-fold move in gold if you did that. So it's hard to utilize that information in that way. But the one correlation that we have noticed is that some of the big swings in the dollar index, like the dollar index peaked in early 2000, .com top, dropped to 2002 low, .com collapse, S&P. made a low, about 6 months before the stock market in 2008. Stock market bottomed in March 2009. They both what? Zigzagged higher since that low in 2008. Uh, and a lot of the swings are fairly well coordinated. In fact, look at the March-April break in the dollar, which was a sharp drop. Same thing with the S&P. The difference right now is the diversion in the strength of the rally. The dollar's anemic, S&P's teasing everybody. But if that dollar is really breaking down, as we argue, then these broad trends argue, maybe the S&P is going to join it again. Just a sideline factor to pay attention to.
Despite enthusiasm in equity markets, gold has quietly matched or outperformed the S&P 500 on a decade-long horizon, something many investors never noticed. The long consolidation between 2015 and 2023 built a massive foundation that now supports the next major advance. Historical bull markets in gold have delivered eightfold gains from trough to peak. Today's cycle has only moved fourfold so far, suggesting it may be only halfway through. As fiscal pressures intensify and global debt exceeds $315 trillion, monetary metals offer a counterweight to what many analysts describe as an increasingly fragile financial order.
What you're looking at is a spread chart, meaning I divide an ounce of gold. I use the front month active COMEX future. Right now, that'd be the February 26 contract. December is in delivery, so we rotate to the Feb. So the February gold contract, which right now is 42.40, I think, as we speak. But last month, these are monthly closes you're looking at here, are plotted. What's the price of gold expressed as a percent of the price of the S&P? And you just simply plot those charts every month. Here we go back to 2013, and that was the year in which gold, after the 2011 high, really started to implode in 2013. And naturally, its relative performance to the S&P, this spread chart, was in collapse mode as well. Okay. And by the time you got to late 2015, that spread dropped down to about 50%. That's on the left side of that chart there, where the first low, just above 50. And gold at that point, if you draw a line sideways from late 2015 on this spread chart, you'll notice it's been above and below that level, zigzagging for 10 years. So almost you could say gold's been par to the S&P in terms of performance. Sometimes better, sometimes worse, but net on balance at that, let's say that low in 2015 at about 51%. It's been either side of it. So you could have flipped the coin back in 2015 and bought gold or bought the S&P. And for most of those years, you'd be making money or losing money or making money, nothing, in other words, okay? Right now, what's happened is that close in November took out a 1, 2, 3, 4-point trend line, almost flat, across every single rally high in that spread, going back to 2014 rally, in late 2014, its first peak. That is a beautiful trend line. If this were a price chart of ABC stock, and you broke out over that line, and you were looking at the price chart, what would you say? Oh, we have a breakout. I got to buy that thing, okay? This is a fresh breakout. What it's saying is, yeah, we've seen strength in gold since early, 2024, actually. You can see it spread went from 40% up to 60. But it's only just now broken out. So this game is really just beginning. The movement of money into gold, monetary metals, and out of the stock market.
The widening gap between gold's breakout and the dollar's stalled recovery hints at an approaching realignment in global markets. Momentum indicators point to the early stage of a multi-year trend rather than a short-term reaction. If this pattern continues, the dollar may revisit or even undercut its 2008 lows, while gold could extend toward levels consistent with previous bull market dimensionality, potentially the mid-$8,000 range. Whether stocks follow the dollar downward is still unfolding, but history suggests they often converge. For investors, this environment underscores a rising premium on real assets over paper promises.
We run momentum studies of these charts too. In fact, later on we'll look at one regarding silver. But the point is that when you get this kind of breakout, and its momentum has also done the same thing except earlier, it's saying something big. It's saying this is a monstrous base of monetary metals holding their ground versus the paper bubble. Everybody's cheering the stock market for the last 10 years, but nobody's noticing that you could have flipped the coin every 6 months and either been ahead or behind in gold relative to the stock market, but basically net sideways, meaning as well as the S&P. Nobody notices that. And I love that because they notice it later, you know. But anyway, this is a breakout and it indicates something. You're not going up for 2-3 months here. This is going up for a couple of years. And God knows where it's going. But this is a massive base that will have a massive move. And it just began. So people who look at a gold chart say, oh my gosh, that's so steep. It's gained so much ground. They need to step back a bit. And another thing about gold, if you go back for the last 50 years since it was legalized in the US, you had two bull markets that were eightfold, bear low to bull high. It was 1976 bear low to 1980 high, 2001 to 2011. Both were eightfold dimension gains from low to high. We're only fourfold. Our low was 1,050. We're 4,200. You go about mid 8,000 area and you can say, oh, I've at least matched the two prior bull markets in terms of dimensionality. So even on that metric, gold is hardly overdone. Okay.